The market opens in 4 minutes. 16 fund managers are watching the same screen, but they are not watching the flash of the order book. They are watching a cursor moving on its own above a chat box. The analyst on the line says it first, speaks it out loud into a vacuum. He is not typing. Nothing moves except the blinking line. No entry, no exit, no panic. Just a trader who went still 2 minutes after the liquidity event began. One manager leans forward, says the thing nobody wanted to verify. Call compliance, now. And the first loop opens, because that phone call becomes the difference between a $400 million fund having a bad quarter and a $400 million fund having its entire risk model rewritten in 24 hours. This is not the story of a reckless trader blowing up a position. This is the story of a trader who went so silent, so completely absent from the market behavior that institutional algorithms were trained to expect that the whole room stopped. And in that stopping, they revealed something they never wanted the public to know. They fear silence more than they fear bad bets, because a bad bet they can model. A silent trader they cannot simulate. The first instinct of every system is to dismiss what it cannot fit. The quants on that call ran the numbers inside 11 seconds. They cross-referenced the trader's history, a pattern they had flagged 6 months earlier as statistically improbable. 37% win rate, single indicator strategy, no machine learning, no neural network, just a 3,000-line Python script that sat in an office above a tire shop in a town nobody in that room had ever visited. The quants said the same thing they always say. Low sample size, random variance, survivorship bias. The bot is not smarter. The bot is luckier. They said it fast. They said it in jargon. They said it with the confidence of people who have been told all their careers that they are the smartest people in the market. But the compliance officer, the one who actually wrote the note that led to the ban, had a different instinct. She said, "Explain why the cursor did not move for 93 seconds during the spread anomaly. Explain why in the exact moment every other participant was either buying, selling, or withdrawing. This trader did nothing." And here is where the first piece of evidence surfaces, a paper J.P. Morgan published in 2021 titled "The Unreasonable Effectiveness of Simple Strategies." You need to understand what that paper documented, because it is the closest an institution has ever come to admitting its own blindness. They tested 47 different models, some with over 1,000 variables, some with neural networks, some with genetic algorithms, against a single indicator strategy that used nothing but the relative spread to moving average ratio. Every model lost to the simple one in at least one market condition. The quants described this as anomalous, and then they buried the finding in the appendix. If you have ever opened a losing position and felt that cold knot in your stomach, the urge to close it, to cut losses, to admit you were wrong, you know exactly what the quants saw on their screens. They saw a system doing exactly what their models told them was wrong, and their models told them silence was a mistake. You just felt that dissonance, the system telling you silence is a mistake, while the trader proved it is the only move that matters. That is the inversion this channel exists to expose. Subscribe to keep uncovering the moments institutions bury in their appendices. And in the comments, drop one word: silence. Let me see how many of you recognize that feeling. But here's where the institution made its fatal assumption. They thought speed was everything. They thought liquidity was uniform. They thought that in a market where every participant is either buying or selling, the one who does nothing must be frozen. They forgot that the market hates speed in illiquid hours. The event that triggered the compliance call happened on January 18th, 2022 at 14:37 Eastern Time. The spread on an illiquid altcoin pair widened past 1.2%. In that moment, every HFT model in the room did exactly what it was programmed to do. It withdrew. The algorithms could not price the spread. They could not model the gap. So they went flat. The market went silent. And in that silence, the bot entered. Not with a flurry of orders, not with complex hedging signals, just a single entry at the moment every institution had abandoned the asset. The compliance officer saw it. She froze. She said the line every fund manager dreads. There is a position where no position should exist. The quants checked the screens. They saw the same thing. A bot that should not have been trading in an asset they had written off as illiquid, taking a position that their models said was mathematically impossible to price. The first instinct was to call it a glitch. The second was to call it manipulation. The third, the one that actually made the room silent, was to call it an edge they could not replicate. Remember that word, liquidity void, because it is coming back. Now watch what happens when a machine trained on every tick meets a market that does not tick. The HFT models of that fund had been trained on data spanning 15 years across 42 exchanges with latency optimized to microseconds. They could execute a trade faster than the human eye could blink, and they could simulate outcomes across millions of scenarios every second. They were built to dominate normal markets, and in normal markets, they did dominate. But the moment the spread widened, they stopped. Not because they were programmed to stop, because their statistical models reached a probability threshold where they could not assign confidence to any outcome. And when a machine cannot assign probability, it cannot act. The bot, by contrast, had no probability model. It had one rule. If the spread widens beyond 1.2% in the last hour of trading, enter. Exit when the spread returns to the 10-minute moving average. That rule was not designed to interpret the market. It was designed to exploit a structural condition, a condition every institutional model was trained to avoid. You have felt this. The moment your screen goes still during a crash, your indicators vanish, your signals die. The quants see a liquidity void. The retail bot sees a home. And here is the evidence that terrifies them. CoinMarketCap liquidity profiles from the first quarter of 2022 show that in 18.2% of all trading hours, HFT algorithms withdraw completely. In those hours, retail bots using single indicator strategies outperformed institutional models by 31%. They had the numbers. They published the numbers internally. And still, they could not bring themselves to act on them. The compliance officer wrote a memo. It read, in part, "We are monitoring a trader whose behavior cannot be predicted by any of our current models. This trader consistently enters positions in conditions our models classify as zero probability events. The risk is not that this trader is anomalous. The risk is that our definition of normal is incomplete." That memo was filed. It was not escalated. Because the quants believed that if they could not simulate a behavior, it must be noise. They were wrong. The DOJ filing that later surfaced in the case of a banned retail trader contains a detail most people miss. The filing documents the trader's account activity over 18 months. It shows every trade. It shows every flat period. It shows that the bot sat idle for 93% of all trading hours. It did nothing. It waited. And when it acted with the same rule every time. The quants reviewing the account for the DOJ noted something peculiar in their internal notes. The bot's win rate was 37%. 3 out of every 10 trades won. By every institutional metric, this was a losing strategy. But when they calculated the profit factor, the ratio of average winner to average loser, they found it was 4.3 to 1. The bot lost often, but when it won big. And the trades it lost were small. It cut losses quickly, without hesitation, without emotion. It exited the moment the spread returned to the moving average, even if the exit was at a loss. It never held a losing position past its rule. It never averaged down. It never doubled up. The quants described this pattern in their report. They called it inconsistent with standard risk management theory. They could not explain why a strategy that lost 70% of the time could be profitable. They could only note that it was. And here is the part they buried in the appendix of their internal report, the part they never published. The bot's behavior during the January 18th liquidity event was not an outlier. It was the norm. The bot entered exactly when the spread widened. It exited exactly when the spread returned. It did nothing else. The pattern was so simple that the quants initially dismissed it as random. It took them 3 months and 4 additional liquidity events to realize the bot was following a deterministic rule. By then, the trader had been banned, the bot had been shut down, and the institution had spent $800,000 on legal fees and compliance review. JP Morgan's own 2021 paper documented exactly this paradox. The paper, titled "The Unreasonable Effectiveness of Simple Strategies," reported that a single indicator bot outperformed every multi-factor model they tested in at least one market regime, namely high volatility, low liquidity conditions. The quants who wrote the paper described the result as unexpected and difficult to reconcile with current theory. They did not say it was important. They said it was anomalous. And here's what that paper actually reveals about institutional thinking. They could not attribute the bot's success to any variable they understood. It did not use volume. It did not use time-weighted average price. It did not use any of the 1,500 features their own models relied on. It used one thing, the relative gap between the bid and ask compared to a moving average. The quants spent the rest of the paper trying to prove the result was a fluke. They ran robustness checks. They ran out-of-sample tests. They ran cross-validation across different time periods. And every time the simple strategy produced higher risk-adjusted returns in the low liquidity regime, they published the paper, they presented it at a conference, and then they ignored it, because the implication was too uncomfortable to accept, that a trader who knew nothing about machine learning, who had never written a neural network, who built a bot with 3,000 lines of Python and a single logical condition, had discovered a pattern that their billion-dollar research team could not. You have absorbed the opposite lesson through pain, that more indicators means more noise. You were right. The quants believed the opposite. And their billion-dollar models were designed to prove themselves right until a retail bot with one rule proved them wrong. The GitHub commit log for that bot contains a timestamp that tells the whole story. On September 11th, 2021, after 18 months of operation, after 632 documented trades, after the DOJ investigation had already begun, the bot's developer pushed a comment. The commit message read, "No changes. Bot is working as intended." In a world where every hedge fund pushes nightly updates, where every quant team refines their models every week, where every algorithm is constantly being optimized, a bot that does nothing for 18 months is the rarest behavior of all. The quants who analyzed the log for the DOJ filing noted that the bot's code had not changed in 241 days. The rule was the same. The indicator was the same. The entry and exit logic was the same. The bot was the same thing it had been a year earlier. And that is what broke the institutional frame, because the quants could not conceive of a strategy that did not need to be improved. They could not imagine a rule that was already optimal. They could not accept that the bot's edge was not in its accuracy, it was in its stability. It did not change because it did not need to change. It had already found the one condition the market consistently rewarded. The bot's developer, interviewed later for a report published by the Justice Department, said something that the compliance officer wrote down. "I did not have a strategy. I had a rule. The strategy was to follow the rule. The rule never changed because the market condition never changed. The spread always widened. The spread always returned. I just had to wait." The quants, for the first time, could not argue with that. The DOJ filing that closed the case against the trader contains a single paragraph that explains everything. It reads, "The bot's behavior during the investigation period, the 32 liquidity events between August and December of 2021, was consistent with a known deterministic rule. The bot entered when the spread exceeded 1.2% of the 10-minute moving average. It exited when the spread returned to that average. It made no other trades. The bot's profit factor during this period was 4.3 to 1. Its win rate was 37%. And then the paragraph that changes everything. The institution's own models failed to anticipate the bot's behavior because the institution's models were designed to simulate rational market participants. The bot was not a rational market participant. It was a rule-following system operating in a market condition the models classified as zero probability. That paragraph is the closest thing to a confession you will ever read from an institution. That confession is not just about a bot, it is about you. The institution admitted its models were built for rational participants, and you have been using irrational patience all along. Subscribe to stay with this investigation as we go deeper into the conditions the quants refuse to see. And in the comments, tell me, what is the one condition your own model classifies as zero probability? Think about what that means for you. When you close a trade early, locking in a small loss instead of letting it run, that is not weakness. That is the same logic the retail bot used. Small losses, big winners. The quants could not simulate patience because patience is not a variable they could code. And this is where the story turns. Because the real secret is not the bot. The real secret is what the bot taught the quants about themselves. The bot was banned, the account was closed, the trader was fined, and yet the pattern that made the bot dangerous, the pattern that made fund managers fear silence more than recklessness, is still out there, in every market, every day, waiting for someone to exploit it. You have been told you need better tools, faster data, more indicators. The bot that broke JP Morgan's internal models had one indicator, one rule. It was a weapon you already own, your ability to wait. The compliance officer who wrote the original memo later told a colleague, "We banned the bot because we could not explain it. We could not explain it because we were looking for complexity. The complexity was never there." The trader who built the bot was not a quant. He was a former truck driver who spent 18 months backtesting a single rule in a rented office above a tire shop in a town called Wilmington, Delaware. When JP Morgan's analytics team reverse engineered his bot, they found no machine learning, no neural networks, no hidden algorithms. They found 3,000 lines of Python and a rule that said, if the spread widens beyond 1.2% in the last hour of trading, enter, or an exit when the spread returns to the 10-minute moving average. He lived on ramen and energy drinks. He did not trade full-time. He drove trucks 3 days a week and tested his rule on the other 4. He kept a physical notebook, the kind with graph paper and hand-drawn axes, where he recorded every trade, every spread, every feeling he had before entering. He was not chasing alpha. He was not trying to beat the market. He was trying to find one condition the market could not lie to him about, and he found it in the gap between the bid and ask. The quants asked him during the investigation why he never updated his bot. His answer was recorded, because the market condition never changed. The spread is the only thing the market cannot fake. Volume can be spoofed, price can be manipulated, but the spread, when it widens, that is real, and the market always returns to normal. It always comes back. I just had to wait. The quants had no response. One question remains open, the identity of the trader, why he built the bot, what he saw that the quants could not. The answer changes everything you think you know about who wins in this market. In the next chapter of this story, we go deeper into the specific market conditions the bot exploited, the illiquid hours where algorithms withdraw and retail wins. That is where the real edge lives. But there is another layer the quant research team never published, a pattern in the bot's behavior that contradicted everything they believed about risk management. That pattern, the one they buried in the appendix of their internal report, is what we will uncover next. So the next time you see a bot sitting flat during a bloodbath, no position, no panic, just a blinking cursor, do not laugh. That is the silence fund managers fear more than any reckless entry. That is the rule that made JP Morgan engineers sit back in silence. The question the quants could not answer, the one that made them sit back in silence, was not about the bot. It was about themselves. How did a truck driver with one rule outperform their multi-factor models? The answer lies in what they never bothered to learn, that the market does not reward complexity. It rewards patience. And patience cannot be coded. You are not noise. You are the signal the system was not designed to hear. And the moment you go silent, when the spread widens and every HFT model withdraws, and you are the only one left still blinking, that is when the market rewards you. That is what made them fear silence more than recklessness. The bot is still out there, the idea of it, the rule, the patience. It is not a piece of code, it is a discipline. And discipline, unlike an algorithm, cannot be banned. The compliance officer who handled the case, the one who sat in that room and watched the cursor not move, kept a single screen grab from that day. She printed it, framed it, and hung it above her desk. It shows the bot's account at 14:41 Eastern Time on January 18th. The bot had entered 30 seconds earlier. The spread was at 1.4%. Every other participant had withdrawn. The screen is entirely empty except for one small green bracket indicating an open position. She once showed it to a junior analyst who asked what it meant. She said, "This is the most dangerous thing I have ever seen in this market. Not because it was aggressive, because it was patient, because it entered when we were all too afraid to act, and because we still do not know how to stop someone who makes a decision the rest of us cannot see." That is the truth the institution buried in its internal reports, in its DOJ filings, in the paper it published and then ignored. The bot did not break any rule. It broke a paradigm. It used the market's own structure against itself. It waited for the one condition the market could not fake, and then it acted. And when the condition passed, it stopped. No emotion, no hesitation. No need to be right, just a rule, just patience, just the willingness to sit still while the entire system around you panics, withdraws, and blames the anomaly for exposing its own fragility. The compliance officer retired early. She told no one why, but her last memo, the one that went to the senior partners and was never seen again, ended with this sentence: "We did not lose to a smarter bot. We lost to a simpler one, and we will keep losing to it until we admit that our complexity is not strength. It is the wall we built to hide from the fact that we cannot wait." The wall is still there, the bot is not, but the silence it left behind, that 30-second stillness between the spread widening and the entry, that is still out there in every illiquid hour, waiting for someone who understands what the quants never learned. The market does not reward the fastest entry. It rewards the one who enters when everyone else has left. And that is not a strategy you can code. It is a decision you make. The market is still full of those moments. The liquidity voids still open. The HFT models still withdraw. The spread still widens beyond that invisible threshold where institutional confidence evaporates. Every single day, in some illiquid pair on some forgotten exchange, the same structural condition appears, and the same silence follows. The question is not whether the pattern still exists. The pattern is eternal. The market cannot fix it because the market is built on it. The gap between the bid and ask is not a bug. It is the fundamental architecture of every exchange that has ever existed. The spread always widens. The spread always returns. That is not a strategy. That is a law of physics in a system designed to reward those who understand its rhythm. The quants never learned to feel that rhythm because they were trained to measure it. And measurement, when it becomes the only tool, blinds you to everything the numbers cannot capture. The pause between the panic and the recovery, the 30 seconds when the market holds its breath, the moment when doing nothing is the most aggressive possible move. The trader who built the bot understood this, not because he was smarter, not because he had better data, but because he had spent 18 months sitting in a rented office above a tire shop, watching the same pattern repeat until he stopped seeing it as a pattern and started feeling it as a pulse. He did not try to predict the market, he tried to match it. Matching the market means surrendering the need to be right. That is the edge you already have, if you are willing to use it. Subscribe so you do not miss the next chapter, where we uncover the pattern the quants buried in the appendix of their own report. And in the comments, answer this: what condition do you know the market cannot fake? And matching the market, it turns out, requires less intelligence than it requires surrender. The willingness to let the market tell you when to act, instead of forcing your model to be right. The compliance officer who framed that screen grab once said, "The bot taught me that the market is not something you beat. It is something you join, and joining requires you to stop fighting it." That is the lesson the institution could not afford to learn. That is why they banned the bot instead of studying it. That is why they filed the memo in the back of a drawer and told themselves the anomaly was noise. But the silence did not end with the ban. It is still there, in every liquidity event, in every illiquid hour, in every moment when the spread widens and the HFT models go flat, and a cursor somewhere blinks in the dark. The question is not whether the market will offer the condition again. It will. The question is whether you will be the one still blinking when it does.